Hey, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today, we're going to be talking about whether or not you should get a single payout or a joint payout with an annuity, or if you should just buy life insurance and get a single payout. Which one's the best? So maybe you're married to someone who is a lot younger than you. Maybe there's a huge age gap and you're wondering, man, if I do this joint payout, my income is going to be way lower versus a single payout. But the problem is, if I die and there's no account balance left, not only will they not get a refund of whatever, there would be nothing left to give them because I've used up all the cash, but there will be no income to continue to them. So that's a problem too. So should I buy life insurance to cover them so they can buy their own annuity contract? Maybe that would make sense, maybe not. So we're going to talk about that because life insurance can be great, but then of course you've got to make sure that the cost of insurance isn't too high. You got to make sure that it's permanent coverage, and that can be very costly. And you got to be healthy. Okay, a lot of those variables, even if they come together perfectly, it can still make the policy very, very expensive. But sometimes I have clients that their spouse sometimes is 15, 20 years younger than them. And when that happens, they have to do a single payout. They could do a joint for sure. There are carriers that will do it. But if you've got a spouse that's 20 years younger and you retire at 60 and they're 40, the insurance company is on the hook for for like 50 years. Okay. And because of that, it's going to be based off of the younger spouse's life, and it's going to be a lot lower than what you could get with a single payout. But you still need to take care of them when you pass away. And so we're going to talk about that. Okay. This is a touchy subject, and some people feel bad if they do a single payout when they're married. They're like, I don't want to do anything wrong. And it just depends. Like if you got assets where your spouse, or they have assets, or they have a pension. Like I just helped someone with an annuity contract, and it's a single payout, but their spouse, they have a huge pension. They got like $82,000 a year coming from the school district, and they've got their own 403b they can use for other income. So it's perfect. Like they keep their assets separate, but not everyone's in that situation. Okay, so we're going to go through the numbers. I'm going to share my screen, and we're going to talk about this together. Okay. All right. So here's what I did. Is I went in, I said someone in Ohio has $500,000. The husband is 58. The wife is 47. So there's an 11-year difference. So with $500,000, they want to retire at 65. They're going to start taking Medicare, and they're going to put the money in right now. So it defers for 7 years. So they get as much growth as possible so that they can get as much income as possible. So looking at that, you can see North American is the top one, followed by Equitrust, followed by American Equity, and all these other carriers. So certain carriers will not give you this. I mean, some of them will just bow out. If there's that much of an age difference, they won't do it. But these ones will. So we're looking at this and say, and just disclaimer, if you're looking for an annuity for yourself, just go to my calculators. Okay, go to johnstevenson.com, check out my calculators, and research. You'll see everything that's available across the market. And then if you feel comfortable, you can book a Zoom meeting with me right there. So, all right, so we'll look at North American. I mean, it's not bad. It's not bad, but you can get more. So we'll say $53,000. Okay, you put the money in there. I mean, you're buying a $1.6 million pension. That's pretty good, right? And your spouse is younger. So if you pass away at 95, okay, in this case, she's going to be 84. She might live another 5-10 years, okay? Yeah, that's pretty substantial. That might be a $2 million pension, right? So that's still decent. That's still decent, okay? But let's say you're like, well, I really would like to just take a single payout, okay? We'll just change this just to a single payout. All right. So yeah, pretty big increase right there. $67,000. So of course the downside is, we'll look at that here right now. See the income comes in great. You're getting a lot more income. But what if you happen to die right at 75? Then you can see the account balance as zero. Therefore, see the death benefit here? It's zero too. Okay. If you die before that, your spouse will get whatever's left in that account for sure. But if they need that income at 75, you probably don't want to buy this. Okay. You probably do not want to buy a single payout. You probably want to get a joint payout. Okay. And with all of these annuity contracts, you don't have to choose whether it's a single or a joint until you activate income. You can buy it, plan to take it as a joint, but maybe 10 years down the road, you're like, oh, actually I want to take a single payout because, they got their other money and they're good, or we got divorced, right? That happens. And so you can just you can just, you could choose either one. When they send you the annuity contract, you will see payout tables, and you'll see different payout rates for a single versus a joint. So if I go back here, let me compare across the board. So just apples to apples. We're going to compare North American only. So North American, here is the joint payout, 6.2. Okay, so it's pretty simple for this. 6.2 times 856,000 and giving you 53,000. Okay, that is a joint payout. Now if I go back to the same contract, okay, $65,000 a year, you notice the benefit base is 856,912. Okay, same as the joint. Okay, benefit base doesn't change. Okay, they're still growing it at 8% every year compounded. The difference is a single payout. Yeah, it's higher, 7.7. So they're multiplying it by that, giving you like, $10,000, $11,000 more per year. So that can be substantial. And so, that's what you have to think about. So if you want the income to continue to your spouse, you have to pick a joint option. Okay, you have to be okay with a little bit lower income. Otherwise, if you're going to do a single payout, you just need to make sure you have a life insurance policy in place for them so that they can buy more income to replace what they just lost when you die, right? Or they need to have separate assets. You just got to make sure that they are covered. And so there's no wrong way to do this, okay? Just because you choose a single payout doesn't mean you don't care about your spouse. You're just doing it in a different way, because a lot of times people can get a lot more income that way, and they'll get two separate policies. Each spouse might do a single payout policies, and they'll keep everything separate. It depends on your situation, but it's important for you to see how this works. And so if you're looking for an annuity for yourself or your spouse, and you're trying to compare single versus joint, check out my website. Go to johnstevenson.com, look at the income rider calculator, and it'll show you all the payouts. It'll show you single versus joint. And then you can decide at that point if that's something that you'd like in your portfolio. Annuities can be a great tool for income in your portfolio. And a lot of people will use them for income only, and then they will use their other assets for other growth opportunities, whether in like growth annuities, which I talk about in other videos, or they could just leave them in the stock market and let them grow, and they'll purchase more annuity contracts later on down the road. It's a great way to just kind of ladder out and continue to increase your income from these. So I hope this is helping. Again, if you're looking for an annuity, book a call right below this video. The link is below this video, or you can go to my website, johnstevenson.com. You're welcome to do it there. But if you don't want to, that's fine too. Just research, find out what's available, use my calculators. It's a great tool, and it will show you what's available, and it's super transparent. So if you got an advisor that's trying to push your product, or maybe two or three, this will let you know if that's the best product or not, because a lot of times they're not. A lot of times they're pushing your product that pays them the most commission and pays you the least amount of income. Okay. And that's not a great trade. So hope this helps. I appreciate you for watching. If you liked the video, like, subscribe, share, comment below if you have questions, and we'll see you next time.